when we talk about the government borrowing money, and this is something that sort of confuses me, despite the number of times people have explained this to me. Um, like we're a sovereign nation with the ability to issue our own currency, right?
Hmm.
Why are we paying interest on the debt? Like it's really like because that's it's a, I don't know what seven it's like hitting all-time highs, like the service in the debt. But if it's just our money, like
Hmm.
why are we paying interest?
So I believe we're like kind of on a path-dependent history, right? So I don't think we could have arrived where we have arrived if we hadn't started at the gold standard, for example. In the gold standard, you had a set amount of gold, and then you had to make sure that the government, when it issues currency, it can have it that arrives in the system as something called reserves. Okay, for the sake of this explanation, but you had to make sure that your reserves could at any time be exchanged for a fixed quantity of gold in storage. So to do that, you needed to control the amount of reserves you had in the system. So the only way to control the amount of reserves to have for the system would be, if you're spending money and creating more reserves, would be to drain those reserves into another type of money that then we call bonds. And those bonds are not convertible into gold. So that way, when the government issued bonds, it was kind of borrowing in order to be able to spend more reserves into the economy. We're not in the gold standard anymore because it was very limiting. It caused a lot of problems. But right now, following that period, um, the bonds then kind of had a different type of a different objective, and that was to achieve a set overnight interest rate by the Bank of England. The Bank of England, at the moment, they have a mandate to control inflation, and they believe that they can control inflation through interest rates. So they have this one lever that they can use. And the way that they use it is they used it because until recently, until QE, that changed a little bit. But up until QE, the way they would do it is they would cause a shortage of reserves between the banks. The reserves sit on the commercial banks' accounts at the government. They would cause a shortage of those reserves and then issue bonds at a set interest rate. And that shortage of reserves caused the banks to have to sort of lend to each other reserves for their daily operations. And when they lent each other reserves, then they would use an interest rate that was in relation to the interest rate that the government was paying on those bonds. Mm-hmm. So the bonds then become a tool for controlling the overnight rate. And that was the main way, that is still the main way in which the government controls inflation. I would argue it's not very effective. And since QE, there's even less of a reason to issue it. But the reason I was saying borrowing is problematic is not the same. It's because what the government is doing is not like it's not taking money and then taking that money and using it somewhere else. Mm-hmm. That money still sits where it is. It simply changes the nature of that money. It's like saying, okay, reserves are blue money, bonds are yellow money. I'm going to change your blue money for yellow money, and the yellow money pays interest, so I'll give you that. It's a government liability in the sense that the government is promising to pay interest on it, mm-hmm. but it's not borrowing in the same way that you and I would do it.
Mm. Okay, so I guess I'm still like I get yeah. Sorry, I don't. Can't we just print it and give it to ourselves and not like why do we have to involve the Bank of England in this? Like what or why do we have to involve like the banks? Like why can't we just print the money and use it without the yeah, I mean
that's a very good point. Well, to do that, I mean, printing money, it's again a term I think that came from the gold standard, and that kind of it made a distinction between what was money that was sort of seen to dilute the value of the reserves against the gold, and that was kind of seen as uh, kind of illegitimate money almost. So that was then called printing money. But now all money is created in the same way, as you say. You know, every time the government spends, money is created.
Hmm.
The Treasury gives an instruction to the Bank of England to mark up the accounts at the commercial banks that hold the accounts of either the government departments or the individuals that the government is paying, and that's it. And there's nothing once the Treasury or better said, once the Parliament has approved payment going out, there is nothing in the system that can stop it. There's no kind of pool of money that people are checking that has been credited before money can go out. No. The consolidated fund, which is the main account that the government has, and by the way, the system is incredibly complicated, but it kind of comes down to the consolidated fund. It goes negative on a daily basis from all the payments the government does. It is policy to have it go back to zero at the end of the day and to transfer whatever negative figure there is on there to another account. That's just the way that the government manages its accounts. But that doesn't mean that it's financially constrained. It's just accounting. It's just moving numbers from one side to the other. Yeah, as you say, there's no reason to issue bonds. There's a strong belief that if you don't issue bonds, that amounts to printing money, and therefore is illegitimate money, and therefore we're all gonna drown in inflation. No, I think that comes from a misunderstanding of what inflation is caused by, and actually, if you issue bonds like we are now, I think last year we paid about £82 billion in interest on the bonds.
Imagine the hospitals we could build.
And remember, we're issuing bonds because presumably that's our way of addressing inflation. And the higher interest rates are supposed to lower inflation. And yet higher interest rates means that we're paying more money on bonds, which means that we have to create more money to pay for these interest rates. So it sounds counterproductive to me. That's one of the reasons that it sounds counterproductive. The other reason is that it's not progressive at all. You're giving money to people that already have funds and have assets in the forms of government bonds. So it's conducive to inequality. And the whole premise of using interest rates to control inflation is also quite inhumane in my view, because you're talking about their thinking is that if they raise interest rates, are going to lower investment, that lowering of investment is going to lower employment, that the rising unemployment is going to cause workers to think twice before negotiating higher wages, and therefore people are not going to have the higher wages to cause the demand in the system that is going to then lead to higher prices. So when they say we're going to help workers by lowering inflation, by increasing interest rates and causing unemployment, make you poorer in order to lower prices, and that's as you're supposed to think as for that, it doesn't really make any sense to me, or it seems a very bad way to do it. So the only policy lever that we have is to punish workers whenever there is high inflation. And, if that's the only tool you have for decades and decades and decades, and of course you're going to see, more and more inequality build up as interest rates benefit the rich, and workers are always being punished whenever there's an issue with the inflation.
Yeah, because I don't know. Cause I think this brings us beautifully onto what actually causes inflation. So my understanding is essentially, and this is my schooling, perhaps it's not quite accurate, but that a massive expansion of the money supply can cause inflation because it feels like you used the word earlier, diluting. You're diluting the value of the monetary token, and
Hmm.
also the cost of energy. That seems to be a massive driver for me of inflation, because I mean, well, yeah, the cost of electric and fuel basically goes up. You can see it in the UK during I think it was the start of the Ukraine war. Like gas prices like went through the roof. Oil prices were also quite high, and then well, then all the electricity companies put the prices up. The fact that the price of gas has now fallen again doesn't seem to have encouraged them to put the prices back down.
Hmm.
That's probably another question, but yeah, it feels to me like the expansion of the money supply and the cost of energy are the two things driving inflation. Like, what is your thoughts?
Right. So you've described sort of the first part that you've described is what we might call demand pull inflation. And the second part related to energy costs is what we might call cost push inflation. So the first one, that's money supply causes inflation. It kind of comes from the monetarists, and particularly from an equation which is MV equals PQ, which is basically money times the velocity of money equals prices times output. They assume the assumption in order for money to M to increase P is that both V and Q, so the velocity of money and output, are constant, which indirectly means that you're assuming full employment. You're assuming that your capacity, you cannot possibly produce more goods if there is, if there's more purchasing power in the economy. You cannot possibly produce more goods to satisfy the purchasing power. I think in terms of what causes inflation, the first thing to understand is that all spending has the potential to cause inflation. So be that spending, be it from the government or from the private sector. And remember, the M in that equation, the term money, is very, very vague. That's one of the problems the monetarists had in the 80s with that equation, is that they didn't know what M should include. There's many definitions of M. You can, if you're talking about all bank deposits, for example, you're including all the credit within the economy. And credit can create demand if again, banks are not constrained in issuing credit. So there is a point where if they issue a lot of credit, like they did in the run up to 2008, I guess, you can create demand in order to push prices up of certain things, like housing was the example back then. So yes, if you have a lot of money going into uh, just just put it simply into a few goods, you can cause that price to go up. So the question there is, are there too few goods? Do we have capacity to absorb the new spending into the economy? So it's not just a matter of, again, what I said earlier about government spending, it's all created the same way. There's no distinction between money printing and non-money printing. There's no reason why money spending and then issuing of bonds is less inflationary than money spending without the issuance of bonds.
Mm-hmm.
It's still causing the same demand, assuming the spending is of the same quantity. So it carries the same risk. The bonds don't make the spending any less inflationary. And as we discussed, it might actually make it more inflationary if you're accounting for interest payments on those bonds. So the question is, are there enough goods and services in the economy to be purchased with that money? And so you might ask yourself if the government is, for example, trying to hire more nurses for the NHS. Are the nurses available to be hired by the government? And if those resources are available to be hired, then why should prices increase? So that's the first part of your statement. And then the second one on the cost push inflation, that is, I largely agree with what you said. There are some prices that are more critical in the economy than other prices. Recently, we saw how important energy was to generating inflation, how sensitive the whole system of prices in the economy was just to that one price going up. And it does mean that, and that's because all industries are interrelated, right? All industries have input from each other, and energy is found in every single industry. There are other things that are found in that are quite crucial. Some basic materials may be quite important as well, but energy being probably the most important. Second only to labor, probably. But so in our case, interest rates are not really going to address that issue that caused the energy prices going up, because it was about international politics. It was about a war. Actually, politics is the reason behind much of the inflation, and it would have been resolved by politics. It reminds me a bit of the 1970s, the oil crisis back then, which was caused by the OPEC raising prices, and of course it's a political event. They wanted to bring problems for the West, so that's what they did. They raised prices and they caused a huge bout of inflation. And of course, we could do nothing about it because we do not control the price of those goods. So the way to have gone about it is to, every time that we import a good into the economy that is as essential for the whole system of prices, then we are putting ourselves at the mercy of fluctuations of that price. Especially, if they're outside the country, then there is very limited things. There's very few things we can do to actually influence that. And even the response of, okay, well, we need to generate more power at home. That's the right attitude, but it would have come in handy 10 years earlier, and to prevent that, because building power stations takes a while, and you might not see the benefits. But it's still a good idea to build resilience to prevent a future event such as that. But that's entirely cost-push inflation.
Hey everyone, thanks for making it right the way to the end of the podcast. I love that you tuned in this long. Do me a favor, hit subscribe, because 80% of you bastards are not subscribing, but you're watching my videos. See you next time.